Good morning. This is Barry Knapp from Ironsides Macroeconomics. This is the introductory free version of our weekly transmission, and audio or video, in this case video, to summarize our weekly note that, again, if you're an introductory subscriber, you received an abbreviated version of. The note was titled 8, or really 9 crazy days, and a little bit of play on Adam Sandler's Hanukkah song. But as we started discussing late last week, just all of the events over the next 8 or 9 days, we just realized how action-packed it's going to be. We can't actually recall a period in our 40 years in the business where we had this many important events up and coming. So to begin with, the backdrop to all this is this seemingly consensus trade to be short the Treasury market, with the idea that the data is strong, and a Trump election, which is looking increasingly likely, will lead to an absolute blowout of the budget deficit. We don't actually think that's right. And this chart that we have in the background here is a incredibly important chart. And the message of the chart, as you can see from the red dotted line, is that government spending is expected to run at nearly 25% of GDP, 24 to 25% of GDP, over the 10-year Congressional Budget Office 10-year forecast horizon. So this is a level that has only ever occurred during recessions, and it's not sustainable. We've never been able to consistently get to 20% of GDP in government receipts or revenues. So without a major restructuring of the tax code, we're not going to close these deficits. And I'll come back to that topic in short order. But let's just consider the events of the next 8, 9, 10 days. First of all, we have what we've been calling for some time belly week. So the Treasury is going to issue 2-year notes, 5-year notes, roughly 70 billion of each of those. They're doing them both today, not on separate days. And then they're going to issue 44 billion of 7-year notes tomorrow. They're going to announce their quarterly borrowing requirements for the next 2 quarters. And then on Wednesday morning, they're going to announce, through the quarterly refunding announcement, the mix of bills versus notes and bonds. Recall, they're issuing more than the Treasury Borrowing Advisory Committee, which is the private sector street bond traders' recommendation of 15 to 20% of total issuance in bills. They're actually issuing closer to 22. So there's some potential for a change in that mix. So all those things are happening early in the week. But as the week progresses, we're also getting labor market data. And it's been clear to us that September was an aberration. We got into that in great detail in the notes. We don't think the labor market's nearly that strong. Now there's a bunch of special factors that are going to make the headline numbers weaker this month, the Boeing strike, the hurricanes and the like. But we think that the foundation of the labor market, small business employment, is much weaker, as evidenced by that big benchmark negative 818,000 revision for the year ended last March. So, we're going to get a lot of data this week that could potentially cause a short squeeze for all those Treasury traders leaning short. And then, of course, next week comes the election and the Fed meeting. And we got into the Fed in this week's note as well. 2 regional bank presidents, Dallas Fed President Logan and Kansas City Fed President Schmidt, are both advocating for the Fed shrinking the duration of their SOMA portfolio, which would be effectively the Fed selling longer duration treasuries or allowing those to mature. And that's another potential wild card that we could get when we get to the Fed meeting a week from Thursday. So this is a period where you ought to consider becoming a full paid subscriber and seeing our updates through the course of the week through our chat function and really get into the details of all this. So I'll wrap up with a couple of things here this week. First of all, on the longer term budget outlook, we heard some buzz this morning that Moody's may want to downgrade the U.S. Treasury. To understand how reconciliation and the Bird rule works, envision a red wave, which is the highest probability outcome, and their primary objective to make the Tax Cuts and Jobs Act cuts permanent. The only way they will be able to do that is come up with either offsetting revenues, and tariffs aren't going to do it. They couldn't be part of this bill anyway, we don't believe, or to cut spending. Now, Elon Musk was talking about cutting $2 trillion of spending. Seems like a lot, but Rand Paul's annual Festivus report came up with $900 billion that he thought could get cut per year, which would more than pay for the Tax Cuts and Jobs Act. And so we do think that there is a chance under a red wave scenario that there will actually be spending cuts, and that spending at 24% of GDP will return to its 40-year average closer to 20, which is where it was under the first 3 years of the Trump administration, even with his deal to bust the budget caps with Pelosi and Schumer in 2018. Under a Harris scenario, their objectives would be additional spending programs like expanded child tax credit or elder care, some of the other things she's talked about. They would try and potentially make their offsets tax hikes. That won't work. We think it's more likely under a Harris scenario, we get at least 24% spending locked in which case the budgetary outlook is actually worse under Harris than it is under Trump. That wouldn't be the market's initial reaction to a Trump victory, but as we get into 2025, that's our longer term budgetary outlook. So earnings growth has been tepid. Beige Group books have been fairly weak. They don't look like a robust economy. We're going to get labor market data that's probably going to say the economy isn't all that robust this week. Could cause a squeeze in the short positions for Treasury traders, but the supply, the election outlook, and potentially the Fed is a bit of a wild card, could all help that Treasury short position. The outlook for the equity market is still pretty good, and we did get into this whole Goldman Sachs longer term outlook forecast in the note. You should be a subscriber to get into all that. But Treasury yields moving up impulsively could be a problem for the equity market for sure. So lots going on this week. We're pretty fired up about it. Again, consider becoming a full subscriber. Barry Neff from Ironsides. Have a good week, everyone. Thank you.